Hey gang, what's happening? Another week, and it's been quite a fun week actually in the stock market. But tonight we're gonna update on these AI portfolios. If you didn't see the live stream last week, that's where we used Chat GPT as well as Gemini to build a diversified dividend portfolio that would work well. And so, they came up with some pretty interesting stuff. And so I took those portfolios. Let me tell you this, though. Those AI things, they cannot add. I don't know what it is. So Chat GPT had two particular positions. So basically we said, hey, here's the amount of money that we have to spend. I don't want any more than 10% cash. And it said, okay, here's how many shares and here's what the market value is. And two of those in the Chat GPT were just off. They, when I multiplied the shares times the going share price, it just did not match. It was way off. So I had to adjust some things. And now I will say this, the Gemini was even worse. I think every one of those was off. So what I did is I took the market value, divided it by the current share price, and came up with my own shares that would match the market value that it told us it wanted to invest. So, I think that works. So, and I'm going to share with you guys those portfolios. But before I do that, we're going to talk about how each portfolio did this past week. Now, I realize that we want to look at this over a long term, but we can't get to long term without short term. So, our portfolios are only a week old. So guess what? That's what we're going to look at, and we're going to look at it, 2 weeks, and then when we get to the point where we're like a year and 2 years out, I think we'll have a lot better picture. But it's kind of fun to look at it, in the short term. So let's see who all's here. If you haven't said hello in the comments, please do that. We got Steve C. Yeah, if the so B is available, that's good. I don't know that my business would ever go profitable, but if it does, that's good to know. Thanks for looking that up, man. What a business. That's right, Shannon. Sorry. There we go. What a business. Fast Eddie's in the house. Good to see you, man. Billy, I'm glad you are here, man. That's it's good stuff. Bernard is here. Good to see you, buddy. Rust Moments is back in the house. And Rust, we ought to get together and collaborate on a live stream sometime. That'd be pretty fun. It'd be the old guy and the young guy. Pat, things are going well, man. It is really smoking hot down here. I think it was supposed to get to 99 degrees. And I think that was only to make us feel better. It was probably 100, but they didn't want to, make us think that it was hotter than it was. But it's hot. It is hot. So tomorrow, I was going to get in the hives today, but by the time, in the morning time is fine. But, when it gets to be around 11, 12 o'clock, which is about the time that I was going to be able to get started, it was just getting hot. And I said, you know what? It ain't going to get any different tomorrow. So tomorrow never comes, right? So I'm getting in the hives tomorrow. I'm going to actually spend a little time in there. And, if I find anything cool, I will share it with you guys next week. But I've got some treatment in there for some pests. So we'll see how that's coming along. And, we'll just see how the bees are doing. They're hopefully making it okay and, staying alive. So and I do know they are alive because I drove by them today and looked at them, and they are still looking good. So ex-dividend dad is here. Good to see you, buddy. And I didn't know, Cookie Monster. I did not know that you were a beekeeper. You have to tell me a little bit about that, and how many hives you have, and how long you've been doing it, and stuff like that. I just find it fascinating. So Michael Swami is here. Good to see you, my friend. Yeah, that would be cool, Russ. Let's do it, man. We don't do anything we don't plan for, so let's plan it. Yeah, thanks for rubbing that in the Upper Peninsula of Michigan, my friend. 58 at night, 75 in the daytime. That is, I think it's probably more like 75 to 80 at night here, and it gets to be about 100 in the day. So hopefully that will begin to subside soon. I mean, what are we, middle of August? So, but I do know it stays hot into mid-September here. So we will just see. I'm just trying to get my bees to live through this wild hot temperature. Brad, it's good to see you, man. Good to see you in the house. So let's take a few minutes here, and I'll hide this extra curricular activity here so to make the screen a little bit bigger. So this is what we're going to talk about. We're going to update on the AI portfolios. So here we go. Are you ready? I'm going to do this from the lowest to the highest, okay? So in this, you're going to see, and let me just kind of back up. What I have done is I've taken the portfolios that were generated by Chat GPT, the portfolio created by Gemini. I then took a snapshot of my portfolio as it was on that particular day. I'm not allowing any changes to any of these portfolios. Whatever we had that day was what moves forward. And then I'm comparing those three portfolios, and then I'm comparing that also with the NASDAQ, with the S&P 500, and with the Dow Jones Industrial Average. So there's 6 things that we're comparing, and I think it's going to be kind of fun to look at. So you ready? We're going to start with the lowest, the one who performed the worst in this past week. Are you ready? I started to say if there's any guesses, but I think it'd take too long. So here we go. The worst. You tell me if you got these, if it kind of worked out the way you thought it would, because I think there's some surprises in here. So our first one, actually our last one, the worst performing portfolio was the Chat GPT portfolio. Now for the week, it made 0.72%, which is not too shabby. I mean, if you take that and multiply it by 52, you come out with, a pretty good annual return. Now we all know that it doesn't work that way, but I mean, 0.72% in a week is not a bad week overall. So, I mean, we would take 0.72% every week, right? Because that gets us to a very nice, probably like 35% gain on the year. So, all right. So Chat GPT, it's the loser. Who's next? It is the Gemini portfolio. The Gemini portfolio returned 0.96% this week. And again, 0.96, not so bad. That's almost 1%. If we did that every week, that'd be 52, somewhere around 50% for the year. I think we would all take that. So, but things were better in the market this week. And so sometimes they go up, sometimes they go down. This happened to be a week where everything went up. But 0.96, that was the number. So what do we have here? We said 6. So that was the number 5 portfolio. Who do you think was a number 4 portfolio? And it is the NASDAQ. Believe it or not, the NASDAQ which is a great return, right? 1.14%, but it was the number 4 return, I guess, for the past 7 days. 5 days, 5 business days, 5 market days, but 7 calendar days. All right, so NASDAQ was number 3. Guess who's NASDAQ's number 4. Guess who's number 3? It is, drum roll, S&P 500. S&P 500 returned. Now, this is not total return. This is just the index return. It is 1.19%, which, again, is a great return for a week. But it still wasn't as good as the number 2 performing common comparison, I guess, for the week was the Wealth Circuit investing portfolio, which actually went up 1.73%, which it was a great week. And for the portfolios themselves, I showed, because we all started with the same value. See that 1664035? That was the portfolio value that we all started with. I did not do that on the index. I don't know that it really matters. But so the Chat GPT portfolio would have gained almost $12,000 for the week, which is, again, not too shabby, right? But then the Gemini portfolio would have returned $16,000. But the Wealth Circuit investing portfolio grew almost $29,000. I almost bought that van this past week. So that's good. And then the number one performing index this week was the Dow Jones Industrial Average, went up 2.13%. And that kind of makes sense. That's, I do have some tech in my portfolio, probably about maybe 15% of my portfolio is tech, but probably more like 25% is industrial. So that's what drove the portfolio higher this week. And, some weeks you're the winner and some weeks you're the loser. And this week, the Wealth Circuit investing portfolio came in number 2. So we're going to keep this on a cumulative basis moving forward. So each week we'll do the countdown, see who's winning. All right, cool. I thought about showing. There's a couple of milestones. Let me know if there's any milestones that you guys are approaching. I think that'd be fun to talk about. There's a couple that I'm looking at, and I'm hoping. Hope's not a strategy, but I'm hoping we get to them. One is, let me see if I can see it in here. Let's just look at it here. This is my my spreadsheet. I'm gonna make it a little bigger so you can see it. The portfolio is approaching 1.7 million. That's what we're looking for. It did actually hit that early Friday morning. The market jumped up at the open, and I actually took a screenshot of that, put it in the Discord. If you're not a member of the Discord, feel free to join us there. It is free. We like to talk about stocks and things like that. You're welcome to join us. And so I'm looking for a $1.7 million portfolio. That's one milestone. But the other milestone is I started actively investing in this portfolio in April of 2021. And so I have kept track of every transaction that was done in this portfolio, whether it made money or lost money. So every dollar that's moved through this portfolio, I've kept a record of that. And historically, you can see it here. We're at $597, almost $598,000 of gain since 2021. So I'm looking forward to that milestone of making $600,000 since April of 2021. That is kind of fun to think about. So anyway, I won't go through all these details here, but you can see them on the screen. And you can see that I've invested in 117 stocks over that. Well, this is, we're in 25 now, so over this 4-year period. So most of them I've gotten rid of, so I have 23 still in the portfolio. And today's winners were Amphenol, United Health, RTX, Parker Hannifin, and Lockheed Martin. Today's losers were EOG Resources, WEC Energy Group, Carlisle Companies, and Atmos Energy, which is one of my, probably the most quality utility that I own, and then Hess Midstream. Now, for those of you who are following Hess Midstream, there is a rumor, maybe it's even pre-rumor. Maybe there's just some scuttlebutt. Maybe that's the way to say it. That Hess Midstream once who is it? Chevron kind of swallows the Hess acquisition that they may turn around and go ahead and try to gobble up the Hess Midstream assets as well. We'll see if that happens. Hess Midstream has been a great investment for me. I mean, if you look at it historically, where is it at? Hess. There it is. Hess Midstream. I've made $21,000 just on Hess Midstream, and a little bit of realized gains, about 14,000 of unrealized, about 6,600 worth of dividends. So it's been a great investment for me. I kind of hope they don't do that, but if they do it, it's going to probably come at a 20-25% premium, and then I'll just have to find another good dividend paying stock. So anyway, I don't know if that's going to happen. I read something online, and if it's on the internet, it's got to be true, right? But we'll see. But it's kind of fun to think about that stuff. I don't invest in Hess Midstream because I think someone's going to buy them. I invest in Hess Midstream because they've got a great management team. They've got a great business model. They are hedged against volumes and prices, and they pay a great dividend. So that's why I invest in them. But if I get a premium for it at some point, that might be okay too. We'll just have to see. All right, where are we at here? Let's get back to the chat and see what is shaking. Who has joined us? Got to get back to where I was. Yeah, Pat or Michael, that is right. Now Michael's in H-Town, and that's wintertime tips down there and here as well. So anywhere from 3 above, night, 20 daytime. Yeah, that's the wintertime temperature for Pat. And I think Pat, that's why. Oh yeah, that's where you said. But I head south in November through April. Pat heads south, and I don't blame him. I think that makes a lot of sense, Pat. You should come down to Alabama and spend a few days sometime during the winter. That'd be kind of fun. All right, Kevin's goal for this experience is to come out and say, Locutus of Borg ain't got nothing on me. I have no idea what that means. I probably shouldn't even read it if I don't know what it means. But I will say this: if I were to go to the Discord, ex-dividend dad wants to be called, just as Warren Buffett is the Oracle of Omaha, I think is what he is. Isn't that right? Oracle of Omaha. I think ex-dividend dad wants to be the I can't even think of what it is now. Something in Notre Dame. Anyway, it was good. I maybe I should go to the Discord, and instead of trying to remember it off the top of my head. Here, I will I'll find it. I don't know if I can find it because I think we moved it from where it was. Yeah, so he wanted to be the Oracle of South Bend, but I think we decided it would be the I don't know what starts with an N. So Oracle starts with an O, and Omaha starts with an O. And if you guys watched Peyton Manning play, you would know that it would be Omaha. Sorry, I shouldn't have done that. But so Oracle of Omaha, so it's O and a O. So if it's going to be South Bend or Notre Dame, it's got to be something with an N or an S. Anyway, I can't think and talk at the same time, so sometimes I just have to stop. Anyway, if you come up with any great names, let ex-dividend dad know. He needs those. 38.4%, 37.44%. I'm not sure what those are, Michael. Maybe I should yeah, I'm not sure. Help me out there, Michael. I'm not sure what those are. AI, this is my buddy Russ. AI is great at telling us where we are and how we got here, but not so much at how long a company will have a competitive advantage. Yeah, that's true. I mean, you would hope it'd be longer than a week, um, but one thing that I did, there was a guy in the Discord, I think it was Jim Betts, this week, asked about a company called JBS, which is a food production company. And so I began pulling up, the financial statements, and I started looking at the company. I'd never really heard of it before. It's actually based out of Brazil. So I looked at their, the slides they present for investor meetings and things like that, and found some things that I thought were kind of. There were some things that were interesting. There were some things that were concerning, just like every company that we invest in, right? So rather than digging into like the 10Ks, 10Qs, trying to figure out what drove those things, I went on and typed into, I don't remember which one it was, one of the AI things, and said, tell me why the cash flow is negative in this particular year for JBS. And it came back with some really good stuff. It was like it read it and it parsed it down and saved me a lot of time, and I was able to share that in the Discord. And but it was really, really good stuff. So yeah, I agree. And we're not good at telling the future either, Russ. That's why each of us probably has a totally different portfolio, is that we all have an idea of what we think the future is going to be, and we invest accordingly. But we're not that good at it either. I include myself in that. There's companies that I got wrong. I mean, I'm still holding UNH, even though it's done really well. And here the last week or so, but I'm holding that. I'm holding Elevance Health, and I'm holding Hershey. Now, Hershey on a total return, I'm positive by a smidge, just a smidge. I mean, if you just looked at the share price, I'm down about 3%. But the dividends, came in that drive me higher. So it's kind of, so the point of that is nobody gets it right all the time. And if anybody says that they get it right all the time, don't listen to them. You need to run. You need to find somebody that's going to be straight with you. It's going to be real with you. So we don't get it right all the time. But you know what's cool about investing in the stock market is, if you have a diversified portfolio, you don't have to get it right every time. You have to get it right more times than not, and you can still be wildly successful. So that's my speech for the evening. All right, here, let's see. UNH is in the Dow. I didn't know that, Michael. That's good to know. That's probably why it's moving so high. Yeah, I didn't know that. So the Dow only has 30 stocks in it, and UNH is evidently one of those. So yeah, thanks for sharing that. I was not aware it was in the Dow. That's good to know. Starboard bought 8.5 million shares of Pfizer last Thursday, since the company looks to be turning around by earning is working to get another upgrade on Sunday. Yeah, I'm not a fan of any of the pharmaceuticals at the moment. And I know I own UNH and I know I own Elevance Health, but those aren't pharmaceuticals. I guess the closest I get is Johnson & Johnson. But Johnson & Johnson has other things other than just pharmaceuticals. So anyway, I'm not sold on any of the pharmaceuticals. Eli Lilly, Novo Nordisk, Pfizer, any of those. None of those impress me at the moment. There's still a bit of risk there, so I think the risk outweighs the reward at this point for me. So, but not everybody's like that. So, and again, I don't always get it right. So we got that. Yeah, UNH is killing it. What did they do for the week? Let me take a look here real quick. Just so here, I'll share this with you guys so you can see it. This is my handy dandy spreadsheet, and I'll pull up UNH, get it up here where you can see it. United Health Group, there it is right there. So you see that? So this is, I own 200 shares of that, which is 3.6% of the portfolio. And you can see I'm down 25%. I was down well over 35%, I think, a week ago. So things have gone very well. And you can see here Hershey is down a smidge, but that is made up in dividends. But if you look at the year, it's down 46%. But if you look at the last 7 days, it's up 13.5%. That is smoking. So, some of that's probably sentiment, and some of that's probably just, FOMO, fear of missing out. And by the way, the Bluey sticker came off the cup, so that's not good. But anyway, half and half iced tea tonight in the Stanley mug. And I brought a lot, so we can stay on here as long as I've got battery for my camera. So yeah, you're right, Billy, man. The UNH has just been killing it. I think some of that's based off of the report, the 13, whatever that is, 13H or G or whatever, that showed that Warren Buffett's company, whether he did or not, I don't know, bought a bunch of shares of UNH, and so that creates this excitement and this interest around UNH. So we'll see how it goes. I rode it all the way down. I'm going to ride this wave, and if I have to ride it down again, that's what I'm going to do, because I think in the long term, I think it's going to be okay. Go starboard. Keep it up. There you go. My sister lives in Arab, Alabama. I used to think that was Arab, but it is actually Arab. Just might stop in and say hi. Man, you should do that. Yeah, anytime, man. Just let me know. We'll grab some coffee somewhere or something like that. But yeah, that'd be fantastic, Pat. I'd love that. Let's do it. Yeah, Nightingale. That's what it was. Thanks for pointing that out, Cookie Monster. It was the Nightingale of Notre Dame, and I suggested that we could call him Flo, short for Florence Nightingale. But anyway, sorry. It's really bad when I say that and he can't defend himself in here. Oops. That's the thing you don't want your heart surgeon to say. You wake up and you hear your surgeon go, oops. I hit the wrong button there. Nostradamus of Notre Dame. That's not bad, Michael. So ex-dividend dad, maybe that's your new handle. Maybe Nostradamus of Notre Dame. That's actually pretty good. I like that. So 1.2% at 52. I'm not sure what those mean either. Yeah, that's it. Swami's got it, man. Swami's all over it every time, man. Anytime there needs to be something figured out, Swami has the answer. Oh, I got you. I think you're helping me with the math on those returns, so I appreciate that, man. Yeah, 60% of the time I'm right every time. There you go. That's the way it is with my portfolio, man. And we do our best to get it right, and we do our due diligence. But at the end of the day, just like AI, we do not know the future. So, if we pick companies that have solid balance sheets, that have a good strategy, that have great capital allocation, that have a good management team and have a good strategy. If we have all five of those things, we will more times than not be right. And here's the cool thing. If we have a great management team, then while we are working our bees, gathering eggs with the chickens, or whatever it is you do, if you are a computer programming, you're all day programming computer stuff, whatever that is, then what really matters is that management team that you have selected. You understand their strategy and you believe in the management team. They are making decisions every day to make you more wealthy. So they are making those decisions. That's why we have to trust in the management team. Our goal is not to try and pick the next high-flying stock. It is to try and pick the management team that can leverage a strategy using the resources of the company to provide a product or service that is usable and useful and is growing every year, so that their balance sheet grows every year. And if that happens, the stock price cannot help but go up. It is just a fact of life. Just like the temperature in the thermometer goes higher when it gets hotter. That's a fact of life. Yeah, I hear you, man. Sometimes they do move a little quick. So I don't think I'm doing too bad, though. Yeah, I think I'm only like 6 minutes behind, so that's not bad. My buddy Russ gets a little bit behind. UNH will get added to SCHD if it sticks at these levels for the next 5 months. Yeah, that might be right. You may be right. They got a relatively decent yield right now. Let me take a look and see what that is. I don't remember. Here, I'll take you guys for a spin with me. We're going to look at UNH. Let me get you guys on the screen. There we go. World of dividends. How about that? UNH. For some reason, it's not cooperating. All right, let's do this. There we go. United Health. All right, dividend yield is 2.87. It was above 3 last week. So it has gone up so much that the dividend yield is going lower. But, I mean, if it continues to recover, maybe not. But, if not, if it drops back down, you could be right. We'll just have to see. We'll have to see. We will have to see. Michael started buying Pfizer first of the year. That was PE was over 40. That now that earning has been beating that PE. Now is 13.3. The dividend of 43 cents has saved me since I bought at 25.53. Yeah, I don't even know what Pfizer's trading for. Let me take a look, just so that I can pretend like I know something about it. 25.07. So that's good. I mean, you got yeah, you're in good shape, man. 25.07 is what it closed at today. You're at 25.53. And if things go well for Pfizer, they could do very well. So, but that's not a bad cost basis, man. Can I look at Equix? I think I've looked at that before. Let me pull it up and see if I recognize it. Equinix. I think I remember this. Yeah, it's a REIT. Yeah, I have looked at that before. Here, I'll pull this up. There, that one. There we go. I'm not even sure if I'm pronouncing it correctly, but it is a real estate REIT for data centers, and I thought that would be a very good investment to make. I guess the issue I had with it, and I'm going way back in the recesses of my brain because it's been a while. It's probably been over a year ago. But the dividend yield is not that great, which means that if we're looking for an 8% return, so I'm looking for my portfolio, this does not mean that this is what you have to look for, but for my portfolio, I want the portfolio to grow at a rate of 8% per year in total return. I want it to give me 8% per year. That can be any combination of dividends or capital growth, or if I decide to play around with some options, it can be, that can be wrapped into it. So if I bought this real estate investment trust called Equinix, I don't know. Then it's only giving me about a 2.5% yield, which means I'm going to have to get growth of about 5.5% from somewhere. Let's see what their 5-year. So now I will say this: their dividend growth has been 10% this past year, 11.6 in the last 5 years. Take a look at that chart; it looks great. What that tells me is, let me look at one thing real quick. And I'll take you with me on this journey. This is really cool. So I want to share this with you. If you joined tonight and you're watching this live stream, if you walk away with just this one thing, I think you're going to have made some money. Okay. So take a look at this adjusted FFO payout ratio. So with REITs, they don't use earnings, they use an adjusted FFO, but that's not what we're talking about. What I want to show you here is that adjusted FFO payout ratio. See how flat it is? And then when I go up here to show you the dividends, see how they're growing? They are paying out more and more dividends every year, but their payout ratio is not growing every year. What does that mean? That means that the business is growing at least the pace that their dividends are growing. And that's what you want. So this is actually not a bad look. I don't have it in my model, but maybe I should put it in. Let me see what Morningstar says about it. I'm not sure if they will have it. Maybe I've forgotten the EQIX. Yeah, EQIX. They don't have it. Oh, there it is. They do have it. Oh, good. They actually have a fair value for it. And they say the fair value is 840 versus 770. So it's about 10%. They say it's within a fair value range, but it's about a 10%. So yeah, it's intriguing to me, ex-dividend dad. I think that actually has some real promise. So maybe I should add this to my model and see what happens, because I will tell you that the companies that I love to invest in are the ones whose dividends are growing significantly, but their payout ratios are flat. And what that means is the business is paying for the dividend increases. It's not debt that's paying for dividend increases, and it's not cash that's paying for dividend increases. It's the growth in the business. That's what we want. This looks pretty good. I'm going to add this to my list. EQIX. I track about 126 stocks on a weekly basis, and so I think it's about to be 127. So yeah, no, I think this looks really good. Let me take a look at some other things. Return on invested capital is not that great, and but they rarely are for real estate investment trusts. What else do we want to look at? Net debt to capital. So they're about 56% debt, which is, again, for a real estate investment trust is not a bad number. They say they want it to be below 50%, but 56% is not terrible. And they have a decent interest coverage ratio. So I don't see anything wrong, ex-dividend dad. Let's see where the analysts think it's going to be. You may have hit on something here, man. This is good stuff. Yeah, so all analysts are saying that there's going to be, I don't know, can you guys see that? I'll make it bigger. They're saying that there's going to be a 24% upside. These are the analysts. So this is an average of all analysts. An average of the top analysts say it's going to be a 21% upside. So 21%, if I'm looking for 8% and this is half wrong, it's 10.5%, right? So that's not a bad looking stock. So yeah, I appreciate you sharing that, man. I'm gonna add that to my my little watch list. That's good stuff. But we can always count on ex-dividend dad to be throwing out some. Oh no, I'm sorry, the Nostradamus of Notre Dame to throw out some really real zingers. So yeah, more and more people take medications as they age that the drug companies should work. Yeah, that's right too. And you got more baby boomers, and folks. There's eventually going to be more people that are in geriatrics than there will be in the workforce. So I get it. I understand the theory. Yeah, 13F. Thanks. I knew it was a letter after it. I just couldn't remember which one it was. I'm not even sure what it stands for. I just know it's a form. Billy, his wife says we got to go. Catch the rest of the video when he gets home. Hey, no problem, man. You be careful. Be safe out there, and we'll catch you on the next one. I appreciate you, man. All right. Fast Eddie says a lot of power to keep them going. I think they're built quite a few down here in the Dallas-Fort Worth area. A lot of power to keep what going? Let me think if I can. Oh, those data centers. Yeah, that's right. That is. And then who's the? I don't know. Anyway, they definitely need some power for those data centers. They've got to, not only do they have to power the computers, they got to power the cooling systems to keep them at a good operating temperature. So that's good. Yeah, dividend EQIX, the last 2 quarters, that dividend was $4.69 each quarter. That's good stuff, man. Yeah, but the share price is like $700, man. That's a lot. I noticed Flow got downgraded. Bead not making bread. Bead is not making bread. Yeah, so the FLO is that Flowers? At one time, I looked at that as well. Yeah, Flowers Foods. Here, let me switch over here for you guys. Yeah, 50 is the it's a borderline safe dividend. They do have a decent yield, 6.3%. Dividend growth is 3%. Yeah, they have steadily been dropping their dividend safety rating. Payout ratio is pretty high, man. 92%. Yeah, last 5 years, 4.8% dividend on average. Take a look at this. So here's what I'm talking about. So if you look back at 2020, the payout ratio was 60%. 2021, it was 67%. 2022 is at 69%. 2023 is 76%. Then we'll go 74%. And then the last 12 months is 80%. And now in the next 12 months, it looks like it's 94%. That's what we don't want. That means that as this dividend, let's see what this dividend has been doing. See how this dividend has been growing? That dividend is growing at a cost of the business. It's almost like you're eating the muscle of the business to grow the dividend because the business is not growing. Let me see if I can get. I like to see myself when I talk like this. There we go. The business is not growing. The business is flat and the dividend is growing. So what's happening is the business is giving up some of its muscle in order to grow the dividend. And what we want is for the business to grow, and that as the business grows, they're sharing some of that growth with us through growing dividends. That's what we want. So I don't like Flowers Foods for that particular reason. It might be way undervalued. That's another thing to keep in mind here. But just the business fundamentals, I think there's some better stocks out there, at least from my perspective, Steve. So, but again, who gets it right 100% of the time? Can you see TPL? I bought some today. Oh, it's good to see you, Hassan. So let's take a look. TPL, Texas Pacific Land. I've heard about this. It's got a, let me show you guys what I'm looking at here. Here, I'll share that. Dividend safety is borderline safe, 60. It's got a dividend yield of 0.72. Man, they are growing the dividend like crazy. Look at that. Look at that chart. 5%. I'm sorry. 5-year dividend growth rate of 23.9%. That's smoking. Let's see what their so their earnings payout ratio is actually doing okay. It is growing, so they are kind of eating away some of the muscle of the company to pay out more and more dividends. So if they didn't grow it quite as fast, that rate would stay low and they would be able to invest more in the business itself. But, I'm sure they've got reasons for doing what they're doing. I just don't, it's not one of the things that makes me happy when I see them eroding the business to grow the dividend. Let me see what let's see what the analysts are saying about it. Actually, they don't have any top analysts. So there are 2 analysts that are following it, and they have a pretty wide range. One says $9.95, and the other says $1,280 per share. So the average is going to be $11.37, and it is currently trading at $8.92. So I guess both of them are high on it, but 2 is not a lot. It's not a lot of analysts, but so what attracted you to it? I noticed that there is only a 0.72% dividend. Let me take a look real quick at where it's been. Oh, yeah, I see that. So last year, year to date, it's down 20%. I think maybe, it might be that it's dropped in price, and so there seems to be some value there. 1 year is 4.73%. 3 year is 53%. 5 year is 362. So they've grown quite a bit. Not recently, but they've grown quite a bit. So, without kind of digging in and seeing what they do, I don't really want to give an opinion on it. But I would say if you like it, man, rock and roll with it. I don't see any real issues with the financial piece of it. Let me see if there's any. Well, the return on invested capital is smoking, like 34%. That is really good. No net debt, and no debt at all. It doesn't even have an interest coverage ratio. So that's sounds like it's pretty solid, but the dividend safety rating makes me wonder. I'm not really sure why they have that as a 60, but yeah, I don't know, man. I guess what I would say for TPL is I would want to do some more. Oh, it's an energy company, oil and gas production. So, and one of the challenges that we have is, and it might be a great time to buy this, right? Because one of the challenges that we face is we don't know what drill baby drill is going to do. And if it drops that oil price down, these oil and gas companies are going to struggle making margins because they make less margins when the prices are lower. So, and that's why I don't have a lot. I do have EOG, but I don't have a lot of other oil and gas stuff at this point. But, this could be one that would be interesting to hold. But it's going to be cyclical, and you want to catch it on the downside, not the upside. So those would be my thoughts on it. EQIX did report earnings on August 14th. Okay, that's good to know. Jim Chanos is betting against Equinix, however you say it, because he thinks big tech companies like Amazon and Google are building their own data centers, which will hurt older data center companies like Equinix. Yeah, that could be. That could be. You got there's another major data center REIT out there. I forget what it's called. I used to own it, but I don't remember what it is. So, but yeah, you're right. That could be. Of course, that's really with everything. I mean, Amazon and Google, if they wanted to insource everything, then they would pretty much shut a lot of stuff down. So we'll just have to see what they want to do. TPL is a great story with virtually no capital requirements. Oh, good. There you go, Hassan. We got Michael Swami, who is long in TPL. So yeah, it might be. I'm going to write that down too. It might be one to take a look at, because I didn't see anything alarming in there. So that's it might be worth adding to the list. So I appreciate you bringing that up. What do I think about? Oh, sorry. Let me put that on here. What do I think about CCI and interest rate cuts? Is that Crown Castle? Let me check it out. Yeah, Crown Castle. So any of the REITs, I think. So check this dividend growth is negative. I haven't looked at them in quite a while, but yeah, they're at a borderline 50. They were at a 40 unsafe. So things must not be doing so well for them. Looks like they're flat here. Oh, they actually dropped it by 32%. Yeah, any of these REITs are going to have a high capital requirement. Yeah, and check that out. 100% of the FFO is paid out in the dividend. That's not a good sign. Free cash flow payout is pretty high. Return on invested capital for REITs not bad. Interest coverage is barely okay. Net debt is pretty high. There's going to be a lot of capital requirements for any of the REITs, and so theoretically, so from a theory perspective, as rates drop, their cost of borrowing drops, which would improve their earnings. So that's a good thing. But from a stock market perspective, most investors understand that. And so whatever they're projecting for rate decreases moving forward is going to be priced into the stock already. So if there's a surprise, then sorry, let me get this out of the way here. If there's a surprise, then it'll benefit the stock in the stock market. But a lot of people already know that those rates coming down are going to benefit. So, I don't know. I wouldn't chase that. I would try to pick the best companies that I could and buy the company, not the stock, because it's lower, if that makes any sense. So that's the way I do it. I don't necessarily look to buy everything at a value. Sometimes I buy it at fair value because I like the management team. I like the strategy. I like the balance sheet. And so sometimes I will pay fair value for a company because I think it's better to own a good company at a fair price than to own a poor company at a undervalued price. So anyway, but what do I know, Bernard? I don't know what's priced in and what's not. I do have a little bit of concern, though, with CCI's financials that I'm seeing here on the screen. Colgate, Procter & Gamble, and FICO also popped up on my screener today. Okay, well, that's, I do follow Colgate. I think that's Colgate, right? CL. Yeah, Colgate Palmolive, and I follow Procter & Gamble. I don't know if I follow FICO, so I'll have to take a look at them. But yeah, they're not popping on my spreadsheet at all. Let's see where let's see where they fall. I'm gonna get rid of everything. I'll take you over there when I get this kind of narrowed down so that you can see it better. Colgate, and who's the other one? Procter and Gamble. LMNOP. Oh, sorry, it's the Procter and Gamble company. I was going, I know I got them in here. All right, here you go. You guys ready for this? Boom. All right, let me make these a little bit bigger. So they are on the watch list. I have no shares in them. I'm showing them with a potential annual return of 6% and 5% respectively. Analysts, though, don't agree with me. The analysts are showing about an 18% return, and for Procter & Gamble, it's 13%. They both have wide moats. Colgate is about right at fair value. Procter & Gamble maybe a little bit higher than that. Man, look at that return on invested capital for Colgate. It's really good, 35%. 19% for Procter & Gamble, so that's not too shabby. Low uncertainty, dividend safety rating in the 90s for both of them. That's fantastic. And their dividend yields are around the mid-twos. So, but I don't see anything that's going to be a drive for additional stock value. So, what I look for is if their dividend is growing and their payout ratio is flat, that means the business is growing, and that's going to add more earnings. If they are way undervalued, then it may be worthwhile to capture that. So, and then I look at dividend income as well. So those are the things I look at, and so I'm looking for something that's going to drive some value. These are great companies, but they got great potential, but I don't see anything that's going to drive big earnings. Maybe I'm missing it. I don't know. Probably am. Usually am. I need to get a drink. All right, but looking at insiders on TPL, hasn't sold any shares, but mostly buying. Yeah, that's a good sign too. Although, and I think that's good to look at. I think the insider investing is good to look at. Having been an insider before, there is, you've heard the adage, there's many reasons to sell a stock, but there's only one reason to buy. That is not true for insiders. There was a time in my career that I had to have a certain percentage, or certain number of times my annual salary invested in company stock. So that meant that I had to buy stock, even if it was not a great value, right? So you have to take that with a bit of grain of salt. Sometimes they're not buying just because they believe in the future of the company. Sometimes they are, but there are other reasons that they buy, not just that. TPL is the largest landowner in Texas. I think I'd heard that, and collects royalties in the Permian Basin oil and gas. They are a cost-free cash flow recipient from oil and gas. Not sure what that means. Cost-free cash flow recipient. Oh, so they, yeah, I'm not sure. I'd have to look into that. I'm not sure what that means. Also own water rights in West Texas. That's good. You need water in West Texas, right? That's awesome. Yeah, so no, that's great, Michael. I appreciate you passing that on. I'm going to look into that further and see if it's not a place that maybe I need to stick a few bucks. Because one of the things I did is where am I at now? I'm only at 1.6% in investable cash. So a couple of weeks ago, when the dip happened, I bought some shares, and I bought some shares of VU. I bought some shares of CSL, and I think I sold my Stanley Black & Decker, something like that. So I ended up with 1.6% of the portfolio sitting in cash, which is pretty low. I don't want it to be more than 10%, but 1.6 is $27,000, not a ton. So but I bought some VU because I didn't really have an individual stock I wanted to invest in. So I bought VU, but it might be time for me to back that VU back down and maybe get into another stock. So, if this TPL looks good, I might have to do that. So ex-dividend dad, they popped up on a screener. Didn't plan on buying EQIX. I'm looking at. Yeah. No, that's right. I guess what I was reacting to is I was expecting it not to be worth looking at, but I think it is. I think it is worth looking at. So I'm glad it showed up on your screener. Inflation has hurt all the food companies. Is why most to all missing earnings. Yeah, I think. I think it's more. I mean, because food doesn't come from China, right? I think it's. I don't know what it is because I know beef is going out of the roof. We bought a whole cow, and from a farmer who lives in our area. We bought the whole cow. We had it processed and it's sitting in our freezer. So, I'm not being impacted by the cost of eggs, the cost of chickens, or the cost of beef, right? Now, we don't have any pork, so we do buy that from the store. So we are kind of impacted by that. But yeah, I don't know really what's going on with the beef, but beef is going to go higher for sure. So TPL doesn't bear the costs of drilling or production. Mailbox money. Gotcha. Okay. So that's good. That means they don't have to put a lot of cash out there. So that's good. I'm gonna have to look into that further, man. One more here. CPB, Campbell's Soup, and Kraft Heinz that made new lows last month. Yeah, I think. Now Campbell's, if my memory is right, is embarking on some new things. So, but no. So everything else is like at highs, and these stocks are at lows. I get the point. My parents bought a whole cow once and even got the head. Now I didn't get the head. I didn't get the tongue. We left that. We left that alone. But we got everything else. So we got a lot of ground beef out in the freezer. We got a lot of steaks, roasts. I don't know what all else we got out there, but whatever else comes on a cow, that's what we got. So it is really handy to have. I've got a smoker outside, so when it's time to, have people over or whatever, I can just throw brisket. We got brisket. We got things like that, so I can throw brisket, ribs, whatever into the smoker, and it works out really, really well. So anyhow, with that, man, we are an hour and 3 minutes into the program. I appreciate you guys being here. It's been fun. Let's do it again next week, and we'll see how these AI portfolios are doing. Probably talk about some other cool stuff. And with that, I will see you guys on the next one. I hope you have a great week, and I will see you soon.